Hey, this is Geoff Gannon, and you're listening to the Focus Compounding Podcast, the podcast where Andrew and I talk general investing concepts. To get even more content from me and Andrew, sign up for the Focus Compounding app. The Focus Compounding app costs $7.95 a month. It comes with a bunch of 2,000-word articles from me each week, a fresh batch of 5-minute videos from the both of us, along with one bonus extra-long episode of the podcast each Saturday, and immediate access to our complete backlog of 200-plus episodes. To sign up, go to focuscompounding.com/app or wherever apps are sold. And now here's Andrew with your regularly scheduled podcast.
And we're back. Thank you so much for tuning in on Sat Talks with Andrew Kuhn and Geoff Gannon. So let's talk about the Shiller PE.
Okay.
What are your thoughts on the Shiller PE? And is 10 years too short to even judge a cycle?
Good question. For some industries and stuff, 10 years is certainly too short. And in terms of when I looked at PE ratios and things like that, the market movements are longer than 10 years. Yeah. However, it generally doesn't matter. All the valuation signals that I think are valuable in terms of giving you indicators for market stuff all usually indicate the same thing at the same time. Now, people could argue about exactly what they're indicating, but they either indicate high priced, extraordinarily high priced, highest price it's ever been, or cheapest or whatever, or range of middle sort of stuff. If there are a few standard deviations off, they're all usually off that way. So people may say to me, oh, the Shiller P or whatever has this flaw in it, but I came up with a normalized PE method that I used those 15 years, and it usually shows the same thing as the Shiller PE, and it would be showing the same thing now. Or there's the Q ratio, which is a replacement cost one, comes up about the same thing, So it tends to happen. And also then you have things like price to sales or price to book or whatever also tend to be the same things hitting, because they're all price and then this. So if price moves a lot, and then the other number isn't moving a lot, then they all kind of indicate the same thing. It's rare that you have totally opposite, unless you put interest rates in. That's when it changes everything, is if you put in stuff that is interest rates.
So when the Fed comes out and says that they don't think they're going to raise interest rates till 2023,
right?
How would that affect the way you think about the Shiller PE then?
That's the argument. So the Shiller PE doesn't take that into account. Yeah.
So then it really comes down to an opportunity cost?
Yes, although it's interesting because if you look historically, it's half and half whether interest rates actually influence PE ratios and stuff. So the theory is that they should, but the reality is that half the time it's been aligned with a sort of approach that would have that. So for instance, you had very, very low normalized PE ratios in the early 1980s. With very, very high interest rates. And that is predicted, and that would make sense. Okay, but the other time that you had very, very, very low PE ratios was actually when you had very, very low interest rates. And that was right after World War II, basically, or during World War II as well. So about 40 years before then. So if you look at the history we have, about half the time the interest rates seem to have lined up in that very high interest rates, very low PE ratios. But then the other times when that's happened, it hasn't lined up. So I don't know. The theory would suggest that, and that'd be very sound economic theory. But I'd say it's been about half and half in terms of empirically what's actually happened. That about half the time interest rates seem to be governing things, and about half the time not. I should point out when I looked at things about the Fed and stuff, people asked a lot about how does the Fed influence stock prices and stuff. I found actually it's easier to reverse it. So stock prices are better at predicting what the Fed will do than the Fed is at driving stock prices. Now, that may not be true over short periods of time, which might be what people are asking, what will it do for the next 6 months? But in terms of normalized P ratios and about earnings and stuff, what is easier to predict is that if earnings are abnormally low, the Fed will cut rates. So for instance, let's say you didn't know what the Fed was going to do, but COVID hit. Well, that predicts the rates will drop for the next several years, right? But then let's say that earnings start coming in above trend. If you drew a trend line, they are consistently coming in above trend. No matter what the Fed says, they're going to have to raise rates. That's more an easier thing to predict. It seems to work both ways. And then, so it's not just that you can use the Fed to predict what will happen with earnings or stock prices. It's actually in a sense that if earnings are particularly strong or particularly weak compared to trend, that actually would predict what the Fed will do. You don't need to model in the Fed there. And that was just a huge question that people ask all the time. I tried my best to find any sort of correlation, and I couldn't find a causative thing. So yes, there's some sort of correlation, but it seems like it's more of a cyclical thing that both of those things kind of happen.
Got it. Cool. Thank you so much for tuning in the video. Make sure you email me your questions, focuscompounding@gmail.com, and we will see you in the next video.